There is a sticker on the front door of your bank. You have walked past it hundreds of times. It says FDIC Insured. And because you have seen that sticker your entire adult life, you assume it means everything inside that bank, every dollar you have deposited, every account you have opened is protected. That assumption is costing seniors across this country tens of thousands of dollars. And I am going to show you exactly why in the next 15 minutes. The sticker is not lying to you. But it is also not telling you the whole story. And the part it leaves out is the part that matters most when a bank actually fails. Stay until the end because the last thing I cover is a free government tool that shows you in about 10 minutes exactly how much of your money is actually protected and how much is sitting there exposed. If you find out you have a gap, I am going to tell you the specific moves that fix it today, not next year, today. If you are not subscribed yet, hit that button and turn on the bell. Banking rules, FDIC coverage structures, and the products sold inside banks change. And when they change, nobody from the government sends you a letter to explain what it means for your specific accounts. That is what this channel is here to do. Subscribe and let's get into it. Here is the sentence that the FDIC actually uses to describe its own coverage. $250,000 per depositor, per insured bank, per ownership category. Read that 3 times if you need to because every word in it matters. Per depositor, per insured bank, per ownership category. Most people hear FDIC insured and think the whole number, every dollar in every account is covered. What the FDIC actually says is that your protection depends on how your accounts are structured, what type of ownership each one falls under, and whether you are within the limit for each category. The sticker on the door is real. The coverage it describes is limited in ways that most people have never been told. Let me walk you through the 4 situations where seniors most commonly discover that their money is less protected than they believed, and then I will show you the one check that resolves all 4 of them in a single step. The first situation is the simplest and the most common. You have more than $250,000 in accounts at the same bank, all under your name alone. This is more common than people think. Seniors who have saved carefully over decades, who have sold a home and parked the proceeds in a savings account, who have received an inheritance and added it to their checking account, can find themselves sitting on $300,000, $400,000, even $500,000 at a single institution. The first $250,000 in a single individual account category is protected. Everything above it at that same bank in that same ownership category is not. If that bank fails on a Friday evening, the money above the limit goes into a claims process, not an overnight deposit. You may recover some of it through the receivership. You may not recover all of it. The FDIC does not guarantee uninsured amounts. It guarantees insured amounts. And the line between those two is $250,000 per ownership category. The second situation is one that banks create themselves by selling products that look like bank accounts but are not. If you have walked into a bank branch and left with an annuity, a mutual fund, a variable life insurance policy, or a product described as a money market fund purchased through the bank's investment desk, those products are not covered by FDIC insurance, not even a dollar of them. The FDIC is explicit on this. Stocks, bonds, mutual funds, annuities, and life insurance products are excluded from deposit insurance regardless of where you purchase them. The phrase that should be on every one of those products is "this is not a deposit, not FDIC insured," and may lose value. It is legally required to be disclosed, but that disclosure happens at signing in small print while a representative is walking you through paperwork. And for many seniors, it never fully registers. The product looks like a bank product. It was purchased at a bank. The bank has the FDIC sticker on the door. The connection feels complete when it is not. Last winter, a woman in Cleveland named Margaret shared her situation in a retirement finance group. Her husband had passed 3 years earlier, and she had consolidated everything, all of their savings, into accounts at the one bank she had used for 40 years. She had a savings account with just over $340,000 in it. She also had what she described as a money market with the bank's financial advisor, which she had opened when interest rates rose and she wanted better returns. Her nephew, who works in finance, sat with her over the holidays and pulled up the FDIC website. He ran her savings account through the estimator and showed her that $90,000 of the $340 was sitting above the insured limit. Then he looked at the money market product and found that it was a money market mutual fund held through the bank's brokerage arm, not a money market deposit account. It carried no FDIC insurance at all. Margaret had believed her money was completely protected because every branch she walked into had that sticker on the door. Nobody at the bank had ever sat her down and walked through the ownership category structure with her. As she put it publicly in that group, she said she had trusted the sticker for 40 years and nobody ever explained what the sticker did not cover. The third situation involves a rule change that took effect April 1st, 2024, and affected seniors who had trust accounts structured for maximum coverage. Before that date, the FDIC allowed coverage to extend to each named beneficiary on a revocable trust, with no cap on the number of beneficiaries. Some seniors had trust accounts structured with 6, 7, or even 8 beneficiaries, giving them coverage well above $1 million at a single bank. The April 2024 rule change capped the maximum coverage for trust accounts at $1,250,000 per owner, regardless of how many beneficiaries were named above 5. If you had a trust account set up before April 2024 with more than 5 beneficiaries expecting coverage above that cap, your coverage may have been reduced when the new rule took effect. The FDIC applied this change to existing accounts immediately, not just new ones. If nobody told you about this, you are not alone. The rule received very little consumer attention and the banks were not required to notify individual depositors. The fourth situation is the one that creates the most confusion because the two products involved have nearly identical names. A money market account and a money market fund sound like the same thing. They are not. A money market account is a deposit product offered by a bank. It earns interest, may allow some check writing, and is FDIC insured up to $250,000, just like any other deposit account. A money market fund, also called a money market mutual fund, is an investment product. It is not a bank deposit. It is not FDIC insured. It may be held at a brokerage that operates out of the same building as your bank, or it may even be described by a bank employee as a better version of the money market account because it earns slightly more. But the moment it crosses from a deposit account to an investment product, FDIC coverage disappears entirely. The question to ask is simple. Is this a money market deposit account or a money market mutual fund? The answer determines whether you have federal deposit insurance or you do not. Now, here's the one thing I want you to do today, and this is the entire action step this video is built on. Go to ed.fdic.gov. The letters stand for Electronic Deposit Insurance Estimator. It is a free government tool built and maintained by the FDIC itself. You enter your bank, you enter each account you have there along with the account type and balance, and the calculator tells you exactly how much of your money is covered and how much is not. It takes about 10 minutes for a typical set of accounts. It is not a phone call. There is no hold time. There is no form to mail. You sit at your computer or your phone, enter your information, and the government tells you in plain numbers exactly where your protection ends. If you find a gap, the calculator will also show you the account structures that would close it. If you discover that you have more than $250,000 at one bank in a single ownership category, there are 2 clean ways to fix it. The first is to spread the excess to a second FDIC-insured institution. Each bank provides its own separate coverage limit, so moving money to a second bank creates a new and completely separate $250,000 of protection. The second way is to restructure how the account is owned. A joint account with a spouse is insured separately from individual accounts. It provides up to $250,000 per co-owner, meaning a married couple can have up to $500,000 in a joint account at one bank and have all of it covered. A retirement account, such as an IRA held at a bank, is also treated as a separate ownership category and provides its own $250,000 in coverage on top of your individual and joint account limits. There is also a strategy that almost nobody uses and almost nobody knows about, which is the payable on death designation on a standard deposit account. If you name beneficiaries directly on a checking or savings account, sometimes called a POD, or payable on death account, The FDIC extends your coverage by $250,000 for each named beneficiary. If you have a savings account with $250,000 and name two children as beneficiaries on that account, your coverage on that single account becomes $500,000. Three beneficiaries gives you $750,000. The account does not have to be a trust. It does not require an attorney. It is a designation added to an existing account at the bank, often just by updating your account paperwork. It is one of the most powerful and least known FDIC coverage tools available to retirees with larger balances. Here's what I want you to take from this video. The FDIC sticker on your bank's door is real. Since the FDIC was created in 1933, no depositor has ever lost a single dollar of money that was inside the insured limit. That record is perfect, and it is extraordinary. But the sticker describes a structure, not a blanket. The structure has a limit. It has categories. It excludes certain products by name. And it recently changed in a way that affected existing trust accounts without sending a single notification to the people whose coverage was affected. The money you worked 40 years to save deserves 10 minutes of your time on a government website to confirm that the protection you believe exists actually exists in the amount you believe it does. Go to ed.fdic.gov today before you close this video and run your accounts through the estimator. If everything is within the limits, you will sleep better knowing that. If there is a gap, you now know exactly how to close it. Send this video to one person you know who is over 60 and has more than $250,000 saved, not because they are doing anything wrong, because the sticker on their bank's door has never explained what it does not cover. And one 10-minute check on a government website could protect every dollar they have. That is what this channel is here to do. I will see you in the next one.